Hey, this is Sasha. I want to share with you some insight today about trading single options. And this is going to stem from our upcoming class, or really by the time you're watching this video, a class that's live and been recorded. And really the Vega problem that most people don't understand and don't expect when they're trading singles. So stay tuned. I'll share with you some insight here. All right, so this class that we have that you'll be able to purchase is the single option strategy. Right here, it's the rocket strategy, how to trade single options. And you can definitely learn more on our website at Rise to Learn, or just check the description. You can go to Traders Fly and go into the courses section. You'll also be able to see some courses here down towards the bottom as you continue scrolling from our recent live classes and things that we've done. Now, here's some thoughts and insights that I want to share with you when it comes to trading singles, and one of the big issues that people have. When you're trading a single option contract, and let's just take a look at Tesla here. A lot of people go in and they're looking to buy some of these option contracts because they're saying, hey, the stock's going to go up. And they'll go into buying a call option, like let's say somewhere over here, because they're assuming, hey, this stock's going to go up. Now, you might do it 49 days, you might do it less, you might do it like 30 days out. I'd say the average, maybe 30 days is kind of where people stand. So we'll go in that area. And we'll go a little bit out, kind of around a 30 delta. So again, somewhere around the average person, what they're trying to do. We'll buy a single option. I'll show you why this is a really not a smart way to think about it unless you can offset the risk. So there's a couple of problems with this. The first big problem that you have is really the theta risk. So you're going to be losing $59 every single day from the theta or time decay. Here I am with the 815 strike, a call, one contract, and I've got about 36 shares. That's what the 36 delta means. So as it goes up $1, I make $36. If it goes down $1, I lose $36. Okay, so here's the big issue though. As you look into this with a 30+ day option, look at your biggest Greek. Your biggest Greek actually is not the theta, it's not the delta or gamma, it's the Vega. So this is actually the biggest problem. So even though as this stock continues to head higher, you assume you'll be making money. This white line is today. The green line is at expiration. So note here the days. And when you look at this, as this continues to higher, you'll lose theta. But not only theta, you actually will lose Vega, because as stocks go up, okay, so as they head higher, the volatility goes down, and you are long volatility. You need actually volatility to go up, because from options, you make money from price, time, and that Vega. So in this case, if we've got a positive Vega and I'm going up, I'm actually going to be losing money, because when Vega goes down, okay, Vega goes down, okay, I will lose from the Vega perspective. When Vega goes up, I actually make money from the Vega perspective. So the way to look at this is go to this gear icon on the lower right. This is the Thinkorswim platform. You can look at the volatility adjustment area here. And what you'll do is go in and either increase or decrease Vega. In our case, as this stock goes up, there's a couple of factors that we need to do. Number one, it looks like we made a profit, but it may take a few days to do that. So that's why we'll go into this time factor here and increase the time a few days. So there we go. Now, instead of 400, we're down to about $126. And then the other thing that we need to do is we need to adjust this volatility. So as stock prices go up, okay, so as stock goes up, the Vega or volatility actually goes down. So I need to reduce that volatility. So what I'll do is I'll put a negative, and I could start going down with my arrow keys. And what you'll notice here is I'm losing money. So as I'm starting to go down, you could see if it goes down about 3 volatility points, that's 3 times 80, okay? So I'm losing about $240 just from the Vega perspective. Now I made some back from the delta, and I lost some from the theta. So here, lost. Here I made some, and here I lost. So if we don't take any of the date things into account, let's say we nullify the date, let's say we nullify the price, and now as price just heads higher, price heads higher a bit, okay? So let's say I am up 300 and some dollars, But remember, as price heads higher, volatility decreases. So in fact, I'm losing money. So it's a lot less than what most people think. And this is the big issue. And this is what we cover in these courses. So in this course here, this live class that we'll be doing, we'll be covering a lot more of this. And if you've missed this, just go in and you can go to all our courses or training by topic or strategies. There's so much more that we have that's related to this. And then you'll be able to purchase this class. Now, if you want to see some other future classes that we have coming up, which we'll be doing here in the future, definitely sign up to our newsletter list. You can go to our Traders Fly website, just, get on the newsletter list. You can scroll down. There's a bunch of other great classes, courses, and much more. So here's the newsletter list. You can sign up right here. And then once that pop-up is there, just enter your email address and we'll notify you as things released. But that's kind of the big issue that people have when they're trading these single options, is that they just don't get that when we're dealing with these option contracts, there's kind of three main things that make up the value of this option. So this is price, this is your price risk, this is your time risk, and this is your volatility risk. Now together, this comes up with your value, okay? In total, in simple words, this is your final value of the option contract. And you can make money on price, time, or volatility. These are your risks, but they're also your money makers. So that's what's fascinating about them. And if you're looking at your option contract and you've got the biggest Greek is your Vega, then you need to take that into account. And if you're buying a single call option, okay, I've got a call, that Vega actually will work against me, and that's a big issue. Oh no. So if I'm doing it on the put side, it's actually a little bit different, and on the put side it actually works in my favor, because as I buy a put, okay, and stock prices head down, right, they're going this way. So here's our stock price on the bottom, so stock price. So as these stock prices head this way, okay, to the downside, the Vega actually will help me. Now I still lose on the theta, but I make it back with some delta. So, but the good thing here is with a positive Vega, this actually is much more favorable. It helps, that Vega helps me. But the big problem is as it heads up against me, I kind of lose money faster if it goes against me in this type of strategy when I'm trading a single put or buying a single put. So anyways, I want to share that with you as for just understanding these single option contracts and what's going on. So if you're serious and interested in, learning how to trade singles the right way, definitely check out our website at tradersfly.com. You can also check out other great courses here that we have, coaching stuff and more resources, and our full live schedule. So there's also a great start here section. So if you're new to option trading, just go to that options trading 101 and just learn quite a bit more from there. So anyways, thank you so much for joining me. Hope you got a lot out of this. Just made you open up your mind a little bit and learn about the Vega risks associated with buying single call options. And hopefully I'll see you maybe in the class or in a future lesson. Thanks again, and I'll see you next time.